So we'll start with reading number 52 of the level 1 curriculum that will talk about the defining elements of fixed income securities. So to begin with, let's revise that when any corporation or when any individual begins a business or a new industry, we generally require some capital to be put in. That capital can come into the company from two sources. One is equity and other is debt, broadly speaking. So if the new business needs $100 and let's say $50 comes in the form of equity, the agreement with equity holders is that there is no fixed guaranteed return. However, they will get all that is left after meeting the fixed obligations. So the equity holders will be entitled to the profits. If there are no profits, then the equity holders will receive nothing. The fixed income holders, on the other hand, or the debt holders, on the other hand, are guaranteed a fixed return. So these holders do not participate in the profit. They are guaranteed fixed payments and a pre-decided maturity at which their money will be returned. In these next few readings, we'll understand more the characteristics of these fixed income securities issued by governments, corporates, and other bodies, and how the return dynamics of fixed income instruments impact your portfolio. So initially we'll go through some basics and some definitions relating to fixed income securities. Now, the basic features of a fixed income security include first the issuer, that is generally the corporate who is issuing the security, that is he needs the money for a particular project or some other use. The maturity date at which the principal or the initial investment will be returned to the investor. The par value. The par value is the amount that will be returned at maturity. So this par value is generally $100 or $1,000. If not mentioned explicitly, from the scale in the question you can assume the par value to be $100 or $1,000 per bond. The coupon rate is stated as a percentage of par value. This is the fixed rate of interest that the fixed income investor has been promised. So let's assume 10% annual or 10% semi-annual would be the coupon rate and the coupon frequency, which would imply that 10% of $100, that is $10, would be paid every year. If 10% is semi-annual, then 10 divided by 2, that is 5% into 100, or $5 would be paid every 6 months. So these four characteristics and the currency essentially define a fixed income security. So the payments would be made in dollars or euros or some pre-decided currency. So it's fixed income because the coupon rate is guaranteed, the coupon frequency is fixed, and there is a maturity date at which the par value of the bond will be returned. So issuers include corporations, governments, quasi-government entities like municipalities, and supranational entities for instance the International Monetary Fund or the World Bank, etc. Bonds with maturities of 1 year or less are referred to as money market securities, and those with maturities of more than 1 year are called capital market securities. Par value, as we discussed, is the principal amount that will be repaid to the bondholders at maturity. Bonds are trading at a premium if their market price is greater than par value, or they are trading at a discount if their price is less than the par value. So for $100 par value, if the current price of buying this bond is greater than $100, we'll say the bond is trading at a premium and at a discount if vice versa. Coupon is the percentage of par value paid annually or even semi-annually depending on the frequency. Coupon frequency can be annual, semi-annual, quarterly or monthly. There are zero coupon bonds also that will pay no coupon and are pure discount securities. That is, they will pay you $100 at maturity, and today you would pay less than $100 or some discount, and that discount would be an indication of the interest that you have effectively earned. Bonds may be issued in a single currency, dual currency, or with a bondholder's choice of currency, but the currency generally will be predefined at the time of issuance of a fixed income security. So fixed income, because most of the characteristics are fixed, the returns or the cash flows, more importantly, from a fixed income security are fixed. Now, bonds are generally issued with indentures and covenants. So a bond indenture or trust deed is a contract between the bond issuer and the bondholders, which defines all the features that we discussed previously and the issuer's or the borrower's obligations. An indenture specifies the entity issuing the bond, the source of funds for repayment, any assets that may be pledged as collateral, so that if the issuer is unable to meet his payments, the investor or the lenders are authorized to sell this collateral and recover their money. Any credit enhancements or any guarantees that other corporations or individuals have given to the debt, so that if the issuer is unable to pay, other guarantors will pay for the debt, or other credit enhancements may at times be mentioned, and any covenants which the issuer must comply. Covenants are those provisions of the indenture that protect the bondholder's interests. They generally can be of two types, that is negative and affirmative covenants. Negative covenants are the restrictions on the issuer's or the borrower's operating decisions. That is, the issuer cannot issue more debt until he has repaid our debt or repaid the previous debt, or he cannot sell the assets that he has pledged as collateral, or he cannot pay dividends until the debt has been serviced, so on and so forth. So negative covenants are restrictions. Affirmative covenants are actions that must be performed. For example, the interest and principal must be paid on time. The EBITDA to interest ratio must be more than 4 times, etc. are affirmative covenants that the issuer must comply with. So generally, the covenants in the indenture essentially is intended to secure the interests of the lenders. There are certain legal and regulatory matters that affect fixed income securities, so you should be aware of. That is, the place where they are issued and traded, who is the issuing entity, is it the government, is it a corporate, how is the funding being done, what is the collateral, what is the credit enhancement. So domestic bonds trade in the issuer's home country and the home currency. Foreign bonds are from foreign issuers but denominated in the currency of the country where they trade. So an Indian corporate may issue a foreign bond, that is, he may issue a dollar denominated bond for US investors. So it is issued by an Indian company, however the bond has payments and guarantees all in dollars. Euro bonds are issued outside the jurisdiction of any single country and denominated in a currency other than that of the currency in which they trade, or other than that of the country in which they trade. So euro dollar bonds would be issued outside the US, so they may be trading in Japan, or they may be trading in Europe or in Britain. However, they are denominated in dollars. So they are denominated in a currency other than the current country in which they trade. So they are denominated in dollars. They are making payments in dollars, but they are trading in Britain. Issuing, and they are referred to as euro bonds. Euro dollar, euro yen, could be any. Euro yen would be yen denominated bonds, but they are trading outside Japan. Issuing entities may be government or a government agency, a corporation, a holding company, a subsidiary, or a special purpose vehicle. The source of repayment for corporates generally are the cash flows from the business. For sovereign bonds, it is the country's taxing authority or the tax collections. For non-sovereign government bonds like municipalities, again, the source may be a taxing authority, or for corporates and others, it could be revenues from a project or the firm's operations. Securitized bonds are repaid with cash flows from a pool of financial assets. So, securitized bonds are generally bonds for whom the coupon and principal payments are coming from the repayments of a loan. So you have issued a loan. As the borrower pays the interest and principal on that loan, the same is passed on to the bondholders. So the bonds are repaid with the cash flows from a pool of financial assets like mortgages, credit card receivables, auto loans, etc. Bonds are called secured if there is a specific collateral that they are backed by. They will be called unsecured if they represent an overall claim against the issuer's cash flows and assets. So unsecured implies that there is no specific asset that can be sold to recover. It will be the cash flows that the issuer is expected to generate that will be necessary for the repayment on this kind of a bond. Credit enhancement may be internal, that is over collateralization. So if you've given a $100 loan and there is a $200 worth of assets that you have kept with you, and that's called over collateralization. Excess spread tranches with different priority of claims, we'll understand all that at level 2 when we study securitization. Or they can be external, that is you have a surety from some other bank or from some other individual, letters of credit, guarantees, etc. Basically ensure that if you don't perform, there is somebody else who has taken the guarantee or who will perform on behalf of the borrower so that the lender's interests are protected. Generally speaking, the interest income on a fixed income security is taxed as ordinary income, while the gains and losses from selling a bond are taxed at the capital gains tax rate. However, the increase in the value towards par of the original issue discount bonds is considered interest income. So, just to explain, generally speaking, the coupons that you receive will be taxed at 30% or whatever is the income tax rate. So, interest income is like any other income. For zero coupon bonds, where there is no coupon, there is no interest income per se, the bond issues at a discount. So par value may be 1000, but it is issued at 700. Slowly as maturity reaches, the bond will go up to 1000. For such bonds, these increases are treated like interest income and are taxed fully. In United States and in many other countries, interest income from municipal bonds is generally tax exempt at the national level and in the issuer's state. So generally municipal bonds are tax free. You'll understand these regulations better once you understand how the movement and how the valuation of fixed income securities works. Not very important, but we'll go through nonetheless. The most common bond structure is the bullet structure, where coupon is paid periodically and the entire principal value comes at maturity. So for example, a 10% 4-year annual pay $100 par value bond will generally have cash flows of $10 at the end of t equal to 1, $10 at t equal to 2, $10 at t equal to 3, and $110, that is the principal plus coupon, at t equal to 4. This is called the bullet structure of a bond. A bond with an amortizing structure repays part of its principal at each payment date. So at each of these 4 coupon payment dates, a part of the principal is also retired. So in an amortizing structure, the payment would be something like 20, 30, 50, 50 or 60, so that there is not one big lumpy payment at the end. Some amount of the principal is retired with every coupon payment. A fully amortizing structure makes equal payments throughout the bond's life. A partially amortized, so this equal payment will comprise some part interest, some part principal. A partially amortizing structure has a balloon payment at maturity which repays the remaining principal as lump sum. So partially amortizing means some principal is retired, but a lot of it is still retained for maturity when again a balloon payment comes, like in the bullet structure. A sinking fund provision requires the issuer to retire a portion of a bond issue at specified times during the bond's life. So some part of the principal has to be repaid at predefined milestones. So it may be a 4-year bond, but entire principal will not be paid at maturity. After 1.5 years, 2.5 years, some part of the principal has to be retired according to the provisions of the sinking fund. Floating rate notes have coupon rates that adjust based on a reference rate, such as the London Interbank Offered Rate. We'll study this in more detail. So these notes essentially have coupons that are varying. So it's not a fixed 10% coupon. The coupon will still be a percentage of the par value, that is 100 or 1000, but that percentage will vary according to some variable reference rate. Other coupon structures include step-up coupon notes. So herein coupon keeps going up after a particular period. Credit-linked coupon bonds, where the coupon is dependent on the credit quality of the borrower. As the credit quality deteriorates, more coupon has to be paid. As the credit quality improves, less coupon has to be paid. Payment in kind bonds, deferred coupon bonds, where coupon is paid later. Index linked bond, where coupon is dependent on the performance of an index, an equity market index or some other index, or an inflation index many a times. So as inflation goes up, the coupon goes up, vice versa. Some fixed income securities even have equity linked coupon payment. So any kind of a structure potentially can be created as long as there is an issuer and an investor in that structure. So there can be many cash flow structures. You don't need to know the details of each one of them. Just know that there can be various types. The bullet is the most common, and there are amortizing and other more complicated structures also that can be created. A lot of bonds have contingency provisions and embedded options. Embedded options in a bond structure will benefit the party who has the right to exercise that option. So we'll study options in more details when we study derivatives, but understand, call options are generally kept with the issuer. That is, the issuer can call the bond back by paying a fixed lump sum to the investor. He can extinguish the bond or call the bond back. Put options and conversion options are generally with the investor or the bondholder. So the investor can sell the bond back to the issuer, or he can convert the bond into equity depending on the equity price, etc. So some options in the bond structure benefit the issuer, like the call option, and some option, generally like the put option and the conversion option, benefit the bondholder. So call options allow the issuer to redeem the bonds at a specified call price. Put option allows the bondholder to sell the bonds back to the issuer at a specified put price. Conversion options allow the bondholder to exchange bonds for a specified number of shares of the issuer's common stock. We'll study more about convertible bonds at level 2. However, these are some more structures that can be added to a regular bond cash flow or a regular bond agreement. So that was about the basic features or the defining elements of fixed income securities. We'll study more about the characteristics and valuations in the coming readings.